Welcome all to the node. I am Mike, aka Veteran Crypto, and joining me shortly, always fashionably late, is going to be David. But today we got some good news. It looks like markets are moving in a positive direction, at least for the moment. I think it's going to personally. I think it's going to be short lived. Kind of if you look at the data, look at historical data, you can see that, usually, and I'm not the first one to point this out, definitely won't be the last, but after a red June, we usually see a green July. However, if you still hold to the cycle where, most people are still saying that we're adhering to, October looks like it's going to be the bottom. And, and not to say that we're going to, shoot straight up from there. We're still going to see potentially a little more downside or ranging sideways, and eventually we should see an uptick in price of some assets. I personally feel that as this market matures, this crypto technology matures and adoption matures, I think that many of the millions upon millions of tokens out there and projects, I think 95% or more of them are going to go away. They're going to, either, in the short term or midterm, they're going to, go down 95% or more and just never recover. And to that point, honestly, I feel like that there's a lot of projects that are in the top 100, some in the top 10, that potentially are hugely overvalued and are in for a rude awakening when the market actually settles on how to evaluate a lot of these projects, these crypto companies. Because as of right now, it's pure speculation. I mean, you have projects that have no real revenue or fees being generated that are valued at $70 billion.
Are you talking about Enron or Ripple Ron?
I Ripple Ron.
Ripple Ron. Yeah, that's what I thought. Oh man, I agree. I agree 100%. The trifecta that we use, Mike. Most projects, when you try to apply just like basic analysis to most of these things, they utterly fail. And, like most of crypto is still some type of fugazi. Now, there are great projects, though. There are really great projects that generate revenue. And those are the ones that we focus on, the ones that generate revenue, the ones that have real users, real user growth, user adoption, product market fit, and where there is a real value accrual mechanism back to the token. Because you can have users and user growth and product market fit, and the protocol can make a lot of money. But if you swap into the token and there's no mechanism by which those revenues accrue to you, the token holder, then you're really just holding like a meme coin, which sucks, because you might think like, oh, look, but protocol XYZ is making all this money and there's all these users and I own its token. But the guys who run that protocol, they're keeping all the money. So, you got to make sure that there's also value accrual.
No, and there's a lot of projects out there that we've given a low grade to on our grading scale as far as A, B, C, D, F. Simply for that reason. It's do I believe that the company? I mean, like we always use XRP just because it gets so much mind share. But am I bearish on Ripple? Not necessarily. I mean, Ripple's doing all kinds of things. I mean, tonight, me and Jeff, you can't argue with the data. It's
I don't know. I think
XYZ for RWAs. Ripple is it can be bullish, but they've been added to the over 50 different organizations that are part of the DTCC's for RWAs.
We've got to do deep dive research just on Ripple, not even on the token XRP, just literally on Ripple, the business. And what I want to do, Mike, is I want to do multiple pieces of source material on Ripple, the business, going back to like 2012. Because
absolutely.
it's one of the oldest crypto projects, and that's why I dislike it so much, because it spent greater than a decade shipping exactly nada and yet dumping on the heads of retail to fund operations. At least that's my understanding. And so I want to either disprove that hypothesis or I want to prove it.
That's a statement of fact. I mean, they make no, they don't try to hide that fact, especially early on. The way that where do you think they came up with the hundreds of millions of dollars to fight the SEC?
Right? They had no product. There was no product. There was no there.
And they've been fully transparent about that. They have I think it's like 1 billion tokens that get unlocked out of escrow.
So how is that not a scam? How is that not just like a blatant scam?
Because they're fully transparent about it, and people voluntarily freaking
transparently scamming.
Well, it's just, it's not like they tell people, they don't tell people that, they're fully transparent that they sell the token.
Look, it's a good thing that they're transparent in their scammery. That's very nice.
It is what it is. It's I think it would be a lot more scammy if they were claiming they didn't do that. But I think it would be obvious, with the blockchain being open and like it is. But I want to play this real quick because it goes back to, and me and Jeff tonight on Crypto and Chill, we're going to start doing deep dives on content creators. I feel it's important that we start to, and we're going to do it to ourselves too, because I'm not without fault. In DeFi, crypto, and airdrops, I was sure that Casper was gonna be a huge project. I was sure that what's another one? I thought Mammo was gonna do good. I wasn't like super bullish on it. I thought it would do good. What is another one? Kita. We did some really bullish deep dives on Kita, a while back. Before we learned about value capture.
What a bag of dog shit that turned out to be. Jeez.
Well, not necessarily. It's they are starting to do it. It's very early on. Their mainnet isn't fully rolling. It's out. It's live, but it's not fully rolling. They haven't got a ton of adoption, but it is still early on. The tokenomics as they sit are not. It's definitely not super beneficial for the token.
Mike, saying it's early on is a cope, brother.
No, it's not. It's just like Canton. Canton is early on. Canton, it's still inflationary.
But there's a there. There's a big there with Canton.
There's a there. But to say that something doesn't have potential in the future is disingenuous. It's there's
I don't think so. I think that it's done nothing but go down. Nothing but go down. There's no there for KTA.
But that's not. Just because the token price goes down does not mean that the project is a bad project. The project could do great things, just like Ripple could do great things. Does that mean that XRP is going to go up and XRP token holders are going to make a bunch of money? Maybe off speculative pumps.
Maybe.
But are the tokenomics as such that there's value capture for token holders? As it sits now, absolutely not.
Yeah. So who are these guys, Mike? DeFi Dave, Wagme, Alexander, and Pat F. Scott. Who are these guys?
These are all from Aerodrome. So this guy is Alexander is from Aerodrome. You probably might recognize him from that Dromos Labs.
Got it.
Yeah. So I just want to play this real quick because he's saying exactly what we've been preaching about value capture. Check it out.
So what means we're all going to make
the top 100 was 90% of them still do not redistribute value. And that is the fundamental shift that I do think that we will be seeing and are already seeing, is that the investor class is sick and tired of these games. And of course, the non-crypto native investor class, they were never going to buy any of these things anyways, right? As the banks come on chain and non-crypto native funds, they're going to look at fundamentals. They're going to say, what do these tokens do? What do they give me? Do they actually represent a piece of important on-chain infrastructure that I believe will grow, will sustain, and things like that? Mm-hmm. And I think overall, that will be very healthy for our industry. I do think it reduces the universe of interesting assets. significantly, but that is like
He's very
it's time
right
to grow
about
up as an industry.
But this is what we've been talking about here.
that. So Mike, can you bring him back up for a second? I want to be able to talk over his face. So Alexander, Alex, is he one of the core devs at Dromos Labs?
Yes.
Okay. So here's my beef with Dromos Labs and Aerodrome and anyone who says that, these dexes, these liquidity provision dexes, that they return all revenues to token holders. Here's my beef with that. If you're a liquidity provider and you provide liquidity to a pool on one of these dexes, and swap fees are generated with your liquidity, and you earn those swap fees. My beef here is that whenever people mention Aerodrome or Uniswap, for that matter, any of these dexes, and they talk about all the protocol revenues, what they're doing is they're saying that all of those swap fees are protocol revenues. And I think that's disingenuous. I don't think that's real. I don't think that's what it is.
That's not what they're saying. I mean, we on this channel haven't even been able to agree on what constitutes revenue. So I think it's a matter of.
I know what revenue is.
Well, I know you think you know what it is, and I know I think I know what it is. But I know that if I pulled up many examples of actual definitions of revenue, and it didn't align with what you were saying. But you made some valid points that disproved what I was saying. So I think that these assets, just like we had to come up with a trifecta to try to come up with a way to evaluate these crypto projects, I think that there's going to need to be I don't know about new words, but they're going to have to tweak the definitions of some of the TradFi verbiage.
The context. So the context is super, super important. So when fees are generated as a result of a swap being executed using a user's liquidity in a pool, that is not protocol revenue. Protocol revenue is like if you're on, let's say you're on Hyperliquid and you execute a trade.
Everything I've ever seen is Aerodrome always says that 100% of fees goes back to liquidity providers and VE Aero holders. That's the verbiage I've always heard.
Yeah, I know, but it's fake. It's so fake.
It's not though, because I mean the fees that are generated, they go to they pay the liquidity providers, the people that actually put.
It's like a bait and switch type operation going on with that VE33. That's kind of the way that I see it, because when you compare it to Uniswap, for example, if I'm over on Uniswap and I provide liquidity and my liquidity is used to execute a swap, those fees that are generated, I earn those directly in the underlying assets. What Aerodrome does instead is it's like a switcheroo. It'll take those assets and those go back to the people who vote on the pools. And so
if you're staked, then you get paid in Aero. If you're not staked, you get paid in the underlying assets, just like on Uniswap. And
most people stake though.
That's their choice. And if you
and you earn 10% less if you don't stake, which sucks.
Again, your choice. But that 10% that if you don't stake goes to VE Aero holders. So still, that is 100%. It's just a matter of who it goes to.
I still don't see the value there. It seems like it's some type of bait and switch when you compare it to Uniswap. That's what it looks like to me.
Uniswap is just a much simpler model. It's just basically
because there's no bait and switch.
No, it's just you provide liquidity in the pools. They don't have locks. They don't have the stakes and stuff like that. So if you provide liquidity to the pools, you're paid out in fees. Boom, done. With Aerodrome, we don't know all the details about the new model yet. But
that's a problem. Why can't they release details about it? What's going on with that?
We're not using the new model yet. So yes, I would prefer that they be very upfront and just make it all known. Absolutely. I think that's a very poor choice. And I agree with you there. However, it's 100% of the fees do go to liquidity providers, be it, liquidity pools.
Yeah, but those aren't protocol revenues though. See,
No one
that's
ever.
my whole. They always do. Yes, they do. That's the whole problem.
They say 100% of fees go to liquidity providers and VE arrow locks.
Unfortunately, Mike, I think that you may be mistaken here, because on X, whenever I see posts, people.
People or the official team.
Well, you know what? Maybe we can, disprove my statement there.
People say weird shit all the time. I know I say weird shit all the time.
Sure, sure.
I misspeak and use the wrong words, and you correct me all the time.
So let me see if I can find the official Aerodrome account on X real quick, just to see, like, they like to talk about revenues, right? Of course, anyone would talk about revenues. So I want to see if I can find a post.
And again, it's I think that there's still a lot of work to be done on defining what is considered revenue from platform to platform.
But it's super simple. It's super simple.
But like you just said, Uniswap's model is totally different than Aerodrome. So depending on the mechanics, what ends up being considered revenue and what ends up being considered fees and what ends up being considered basically my point is that it seems like there is confusion, and I don't want to dive in this again because we wasted a whole episode on it before.
I don't think it was a waste. I thought it was a great conversation.
It was a great conversation, but I don't want to hijack the whole episode on diving into this again, because I feel like that we debated it to a point that we got a resolution, and that resolution was that there still is a lot. This is still a new industry, and there's still a lot of work to be done to attach the right verbiage to the right mechanics and the right, I guess that's the best way to put it, the right mechanics when it comes to these.
I don't know, Mike. Either people understand, what revenue is in the context of these decentralized protocols, or they don't.
I pulled up the definitions on TradFi, platforms that are universally accepted, and you didn't agree with them. So I don't
because
think
it's wrong in the context. In the context of liquidity provision, brother, it's wrong.
I very much doubt that.
Yeah, I am right. Okay, well, you're wrong too then. I mean, it's not my fault you can't understand what revenue means.
I'm willing. The definition of words are a statement, are statements of fact. And the statements of fact are that the universal accepted definitions of these words in TradFi trumps your personal opinion.
Okay, well, in the context of liquidity provision on a decentralized exchange, I know what I'm talking about. And and
I'm not debating that. My point is that this ecosystem hasn't evolved to a point to where there is universally accepted terminology used for these different parts of the.
But that's my whole point. That's my whole problem. That's my beef. My beef is that they're saying that they generate all this protocol revenue when really it's just
until the words are defined. And I'll use this example again. I know it's silly, but the definition of a woman, when you're talking to somebody that's woke, if you feel like a woman, you're a woman. Whereas if you're thinking it from a logical standpoint and biologically, a woman is someone who's born genetically a woman. They have the right chromosomes and they can reproduce like a woman would. That's the difference. Is there needs to be universally accepted verbiage so that we can have conversations about these things.
So you see what Big Lou is saying in the chat. Let's answer some questions. How much of the platform's profit goes back to users? If so, and how do we even verify this? So I think Big Lou might be talking about the Aerodrome. How much goes back to users? Just in general? Okay.
Yeah, just like is there a data platform that shows? And I'm trying to think if
you could probably use Dune if
Yeah, and I've looked at Dune before, and I definitely remember that it is the case, in Aerodrome's case anyway, that 100% of the fees go either to liquidity pool providers the VE Arrow holders, and that's pretty much it. And anything that's not distributed to those goes back to buying back Arrow and max locking it. So basically burning it. And that's in the old model. Again, I think it's a huge lack of judgment on their part that this close to the launch of the new token and the new protocol potentially this month, that they haven't fully announced all the mechanics and all the tokenomics and stuff. But, it is what it is.
Yeah, I mean, I'm still waiting. I would like to learn from Mr. Wagme Alexander, the CEO over there at Gateway to the Underworld Labs, Dromos Labs. I mean, come on, guy. Like, what's going on, man? You've only been working on this forever, right?
So speaking of data, we got this Keiko that popped up that is working with Broadridge. And those that aren't familiar, Broadridge is pretty much, well, not pretty much, it really is the main revenue generating or fee generating aspect of Canton Network right now. So they're the one that launched all the repos. So this is talking about Broadridge DLR processes 7.5 trillion in monthly repo volume on Canton. This is what is contributing to that $2 to $3 million in fees for the most part. And it averages $357 billion per day. So it looks like Bloomberg terminal subscribers can now monitor that activity through Keiko Data's data off-ramp alongside existing fixed income market data. So I went there and created an account. The problem is that you have to buy this like super expensive what's it called? This super expensive Bloomberg terminal.
Yeah, so Bloomberg is like a couple $1,000s a month.
Yeah, and I'm not willing to do that. So this is, if you want to go create an account, there is some of it that's not premium, and so you can check out some of these charts. One thing that I was able to pull up that I found really interesting was this document, and it had a lot of really good info in here. One of the things I found interesting is the price evolution of the Canton coin versus other main assets. So you got Canton, ETH, Sol, Doge, SUI, Bitcoin, XRP, Cardano, and Link. And if you look at how correlated all of these other assets are, this is what me and David keep talking about, where how Canton seems to have a mind of its own. Same with Hype, just outperforming Bitcoin. And you see that all of these other assets, it's almost like they mirror each other. And and this is what most assets have done historically in crypto. And that's why everybody follows Bitcoin, is whatever Bitcoin does, everything else follows. So this is what the way that the price has moved for Canton. And you can see that as everything else dumped, Canton was pumping. This is because of those fees that are being, what I think, and we've seen a correlation between the two, as the halvings have occurred and as the fees have ramped up for this Broadridge repo market. We have seen that the price moves in a positive direction. We are hoping that here in 6 days, let's go over here. Here we go. It was 7 days yesterday. Here in 6 days, this coming Monday, we are going to see the DTCC soft launch on the Canton Network. So
yeah, that'll be good.
I've been seeing a lot of XRP maxis trying to hype up that Ripple Prime is, and this is going to be a topic for tonight on that we're going to point out on a XRP maxi channel, that they're bullish on XRP simply because Ripple Prime was added to a list of over 50 participants on a panel, basically for the DTCC to onboard TradFi, and RWAs on chain. The only project that they have gone live on that I've been able to find has been Canton Network. and that is going to be here in 6 days. The full launch, I'm sure if everything goes well, of course, is going to be October of this year. So with that will come more fees. How much? We don't know yet. But with more fees, the burn increases. As the burn increases, if we look at the data, we have seen positive price appreciation. And if we can push past that equilibrium and the burn can outpace the mint, I'm excited to see, and I'm not going to guess at what will happen. I think I know, but we're going to see if that is going to make the price of Canton go up in a significant
Potentially,
way.
Potentially could. I mean, if I'm just taking a look at CC right now, looking a little bit shaky, off 4.3% today, trading down to 13.23 cents, and importantly, putting in a lower low, below the bottom of that channel, that little level of support that I had drawn in there. So the CC token starting to break down today. And, I just want to caution everyone, if you've already got a position, DCAing on the way down is not a good idea. You don't DCA into a loser, okay? That's something you don't do, especially with digital assets. Look, I don't know anything about the future. I don't have a crystal ball as much as I wish that I did. And even though, when you take a look at what Canton is building and the success that they're already seeing, and then you compare it to literally like just about any other project, it makes Canton look like it's got a bright future ahead. But I don't own any CC. And because I don't own any CC, that means that I can sit back and wait and watch. Now, if I did own CC, I would not be adding to a losing position on the way down. Now, if you had already opened a position much, much, much lower, and you believe that, maybe you want to speculate that in October and over the next couple of weeks, as these tokenized equities and tokenized treasuries start to trade on Canton, if you want to speculate that that's going to generate more fees, which are going to be used to buy back those and burn those tokens, and eventually we're going to get to a positive burn mint equilibrium. If you want to speculate on that and you've got a lower cost basis than the current spot price, well, then okay. But I would just caution anyone from DCAing into a loser. It's not a good idea. And a lot of people advocate for that.
What's your definition of a loser, though?
Well, if it's showing you a negative P&L, that would be a losing position.
Well, I mean, it would be, a price dip. But I mean, if you're buying, say, like, right now it's like at around like 13.5 cents, and say, and this total, this is hypothetical. In 6 days, say that the amount of fees double, and so the price doubles. I'm not saying go out and buy Canton. I'm just saying if that happens, then potentially that was a good investment. If you're bullish on the project, I definitely see what David's talking about.
Pure speculation.
If you were buying Cardano, or if you were buying, XRP, or you were buying 95% or 98% of altcoins on the way down, you're deeply underwater right now. Your portfolio is way down. So I definitely get where he's coming from. But long term, I mean, if a project is, you feel a project is strong and you're bullish on it and your risk profile is such, wouldn't that be a good move, though?
No,
No,
it's always a bad idea. No. So what's his face? So Paul Tudor Jones, really popularized the maxim losers, average losers, but he's not the one that came up with it. This has been, elite investors and traders over the last couple of centuries in American markets have popularized this. Jesse Livermore,
what happened to buy when there's blood in the streets?
That's different than dollar cost averaging down and pyramiding down into a loser. Much different.
Explain.
Sure. So if you've got an open position that's showing you a loss and you add to that position thinking that you're going to lower your cost basis, That's a hell of a lot different than sitting on cash when markets crash and buying at the lows. Much, much different
Well,
thing.
but now you're trying to time the bottom. What if what if you miss the bottom?
Well, right. I'm just saying that the whole idea of dollar cost averaging down, pyramiding down, adding to a losing position to buy more as the price drops, that violates core principles of risk management. So, while dollar cost
But I
averaging,
mean, if you're high risk, if you have a high risk profile, and you're just bullish on a project like I am on Ken, I bought another $500 when it dipped down to 13 and a half cents. Just because I personally, I'm not saying rush out and buy it right now. David is definitely smarter on this stuff, but me personally, because I have higher risk, I'm willing to buy at that because I'm hoping that in 6 days, that when this launches and the fees, more fees start getting generated, I'm hoping the price goes up. And with the adoption I see with Canton, if it stays correlated to where as more fees are generated and it is correlated to the price, and the price starts going up, I see upside.
So, Mike, what I heard there are a couple of cardinal sins when it comes to short to medium term trading or investing in individual stocks. Well, you kind of are. So, what I heard there was hope.
I'm not buying and selling.
Okay. Well, so DCAing, I think, is a fantastic long-term strategy for investing in something like a broad index like the S&P 500 over the course of 20 years. Or 30 years. I think that is an excellent strategy because we have enough data to be able to say that, hey, over the last 100 years, S&P number go up, and that's all it does. So DCAing, that makes a lot of sense into a broad index. But I think DCAing, and I don't think this has been proven, I think that I believe that it is true that DCAing for short to medium term investing in individual stocks or crypto assets, I think that that's lethal and a cardinal sin. And so here's the thing. You got this math of ruin. So as people DCA down, you're multiplying your risk when a position is not showing you a profit. So when you enter,
absolutely.
So when you enter a trade, you should have some type of predefined risk budget, some type of stop. If price drops and you buy more, you're not just lowering your average entry price, you're increasing your total position size on a trade or an investment that is already proving you wrong. So if the asset continues to fall, but it's the psychological part too, Mike. It messes with your head. And so now as you DCA down, if the asset continues to fall, now your losses compound exponentially. So an investment or a trade that should have been a minor discipline loss.
Early buyers of Bitcoin, or early buyers of Ethereum, or early buyers of a lot of different assets. I mean, absolutely. On any investment, you can lose everything, and especially in crypto, we've all seen that. But
right. Well, yeah. So, it's easy to cherry pick a handful of assets that have been phenomenally successful.
Absolutely. I'm definitely not saying that it's a winning strategy. I'm just saying that, if, out of, say 10 or 20, that you pick, if you're focused on good, fundamentally solid projects like Canton or, like Hype and, things like that have good tokenomics, they have the value capture we talk about, they're generating fees and revenue, they're getting, solid adoption, you're gonna increase your chances. Is it a guarantee? Absolutely not. Is any investing a guarantee? Absolutely not. I mean, we've seen, plenty of people get ruined in this stock market with, as volatile as oil's been and, a bunch of other things. I mean, shit, even, some people, it wasn't even their fault on October 10th, because of stop losses not triggering and shit like that. They got ruined.
Yeah, it was Binance. It was Binance's fault. It was a winter mute special.
And we're gonna be diving into Binance today. I did.
Awesome!
I did Avalanche and BNB for today's deep dives.
Dude, that's going to be fun. Avalanche is an interesting project, and so is BNB. I'm curious about that one.
No, I am too.
So just to finish up on the DCAing down thing. So, market inertia, right? Like the trend is your friend. So assets usually drop for a reason. And when you pyramid down, what you're essentially saying is that you are smarter than the collective order flow that's driving the price down. Markets can stay irrational for much, much longer than individual investors can stay solvent. So pyramiding down, you're assuming that a bounce is imminent, that you know something. But in a downtrend, those supports break.
Solvent would be if you were like using leverage, though, right?
Well, you can go down to zero. Things can go down to zero.
Oh no,
so you don't need to use leverage to lose everything.
No, absolutely. But but again, if you're mitigating, you're not eliminating, but mitigating your risk by not aping into meme coins. You're not aping, but you're investing in solid projects. It's still purely speculative. I mean, I think we can all agree that crypto is still highly speculative. Where this technology is going to go, how long it's going to last. If the ones that are going to be the Amazons or Googles, they might not even exist yet. We don't know. I'm bullish on Canton, but I mean, shit. Tomorrow there could be a massive exploit that unravels the whole thing, and it could go to zero.
Oh, don't say that. Don't say that.
I'm just saying, we've seen crazy shit happen in these markets. I mean, we've seen exploits of Aave, to the tune of hundreds of millions of dollars.
So it wasn't really an exploit of Aave. It was layer 0, and then the follow-on effects impacted Aave.
Yeah, okay. I mean, I got to use the right words. It was an exploit of those, but Aave was used in that. In that exploit to give the people exit liquidity. They deposited that RSE, and because of the what I personally think is a bad architecture, where and we've talked about it, that pooled liquidity.
Yeah,
they were able to extract a large amount of liquidity out of there, and if it wasn't for the rest of the DeFi community,
the bailout, it was the first DeFi bailout ever.
And you know what, I'm kind of okay with it. I mean, I don't know.
I'm not. I don't like it at all.
I mean, I would like to know, where that liquidity came from. Was that users of those other protocols, liquidity? Did they use us as a bailout like the government does, or was that their money?
Well, I mean, a bunch of protocols came together and essentially loaned Aave a bunch of ETH in order to fill the hole.
Did they loan them our ETH? Did they loan them their ETH?
We would have to run some deep dive research on that. That's funny. Nice pun.
You know what I mean, though? It's I don't know. It's so rough. Being early in this technology and these assets, it is a fucking minefield. I mean, I think that if you've been in crypto for more than a month, you understand that this is a minefield that we're navigating.
Yes, it is. And so I just want to one last comment about DCAing down. So this is really the idea of DCAing down is really toxic psychology. You're in hope mode when you're DCAing down, because DCAing down into a losing. No, we're not. So DCAing down into a bad trade, that is rarely a cold, calculated mathematical decision. In 95% of cases, it's almost always an emotional decision driven by some type of cognitive dissonance or fear of loss, fear of the pain of loss.
My math is buy lower than I end up selling. That's my math.
Yeah, buy high, sell higher. Sell low, buy back lower. That's so. There's a couple of books in this space that everyone should read. Tom Hogarth's book. What's the name of that book again? Best Loser Wins. And then, we definitely got to take a look at Jesse Livermore. No doubt about that. Reminiscences of a Stock Operator. I've read that book more times than I can count on both hands.
So everybody out there, you want to be listening to David. I'm a degen. I'm he's much smarter investor. He does it for a living. I'm just devil's advocate. I'm being the contrarian here, and some of this stuff I do. So if you want to be successful, David's the one to listen to. If you want to be degen, I'm the one to listen to. But it's important that you understand what it is that we're talking about and what David is explaining, because he is correct. So
yeah. So
moving
on here,
let's say we got. So this is kind of some of the stuff that I want to talk about while we got about 20 minutes. So the internet allowed us to move copyable information instantly. Tokenization allows us to move unique, uncopyable value natively on chain. Fractional ownership, just as e-commerce allowed people to buy small goods. Tokenization allows investors to buy fractional shares of massive, previously illiquid real-world assets, or RWAs. Continuous 24/7 liquidity. Markets no longer need to close at 4 p.m. Digital assets on Canton or any other network can be traded, settled, and utilized around the clock globally. Programmable asset. Tokenized assets aren't passive pieces of paper. They are smart contracts that can auto-execute dividends, compliance checks, and corporate actions instantly. EVM compatibility via Zenith. We did an interview with with Gustav, their head of ecosystem. Developers don't need to reinvent the wheel. Zenith bridges the familiar Ethereum virtual machine ecosystem straight into the DTCC level institutional security. This is important to understand. When Zenith goes live, it is going to bring EVM compatible smart contracts and dApps to the Canton network. That is going to create interoperability between everything that Canton is doing with the DTCC and everybody else. Important to understand. Atomic settlement, eliminating counterparty risk by ensuring the transfer of an asset and its payment happens simultaneously. No more waiting days for settlement clearance. This is huge for a lot of things. I mean, retail payments, retail, purchases, things like that. Credit cards. It used to, when you swipe your card, it usually it'll come out of your account, and it might show in their account, but for them to be able to actually spend that, for that finality, it usually takes days for that to happen. With RWAs and tokenization and these crypto rails, you can get that atomic settlement to where everything is instant. So that is going to allow liquidity to move more freely. Democratize high yield markets, opening up premier institutional grade assets to a broader global audience. Exactly how e-commerce opened global retail markets to small businesses. So, David, is there anything that you want to jump in on?
Well, what I'm thinking about here is, when are we going to get, not just tokenized assets, but when are we going to get like real on-chain origination, where, because a lot of these, I think probably most, 99%, if I had to guess, of these so-called tokenized assets or RWAs, it's like a mirror image of something that exists in TradFi, taking something that exists in TradFi and mirroring it on chain. Now, that's a hell of a lot different than on-chain origination. So that's what I'm looking forward to, is real on-chain origination, where the assets are originated on-chain, where that's where they live. So it's not like you own an IOU for a stock that lives in some TradFi broker, custody account somewhere. You don't own like an IOU there. What you actually own, the actual tokenized asset, it originated on chain. It was created on chain. It wasn't created by some centralized entity and then mirrored onto some token somewhere. It was actually created on a blockchain.
Gotcha.
That's kind of what I'm looking forward to.
There was like an IPO or something like that. What you're talking about is that that generation event would be just on chain. That's it.
Exactly.
There isn't this, it's in TradFi and it's on chain. You're talking about it exclusively on chain.
And then if you want the TradFi access to it, then you need an RWA in the opposite direction. So
well, and maybe you can answer this. Like, why, if something is originated on chain, why would you even want it to be done the old way?
Probably custody. I would guess, just off the top of my head, because most people don't want to or can't self-custody. And so that means that, having a centralized entity like a bank or a broker custody those assets for you, that's much, much more convenient. And,
could you do that with an RWA though?
Well, if it's originated on chain, you could probably do that too. If it's originated on chain by, a custodian like a broker or a bank or investment bank, then yeah, they could originate it on chain and retain custody of it, and then give clients, the ability to transfer or sell it. Sure, I would think that would be okay.
I'm just wondering if we're going to see this evolution of kind of the old way of handling these assets, if just everything is going to come on chain. I don't see personally, and I could be totally wrong, I don't see a logical reason why to, when you have the option to have something tokenized where it can move 24/7, 365. You can, do fractional ownership. You can borrow against it. You can use it in, DeFi strategies and things like that, both at the institutional level and at the retail level. I don't see the upside to having it, be that, that old TradFi style. But maybe there is. I just can't think of it.
Yeah, I don't see. Well, I think that the upside for the old style is in custody for a lot of people. I think probably the majority of people. But look, you could have that same type of custody with the on-chain assets too. So I think that really it comes down to custody, that most people can't or don't want to self-custody. So that means you need a custodian to handle that for you. That would be a bank or whatever.
I would just think that like the bank or the the institution that was going to custody it for for that individual, that they would just be the onboarding for them. They would give them the fiat. They would buy the RWA. It would be in their account, and if it was in like their wallet, then potentially they could use it. Depending on how that looks, I mean, potentially they could use it for, DeFi or take loans out against it, especially people, high net worth, individuals. They are huge into borrowing against their assets to access that liquidity without incurring a taxable
liquidity.
Yes. So, I mean, it'll be interesting. It'll be interesting to see, how this evolves.
Dude, this chair is killing my hips right now, man. I'm looking at buying a new chair right now, dude. Like, this is it's been messing up my hips so bad.
Dude, I had to invest in a nice chair, but even this one, like the screws broke, the back, the screws, I guess from like leaning back too hard or whatever. Friggin' I snapped them off, and I fucking took a fucking spill, like hard spill backwards. So I had to go get new screws and stuff like that.
I'm squirming in this chair right now, man. It's driving me crazy. So I'm sorry. Continue. Let's see what's going on here.
So this is what we've been talking about. The rolling correlation between Canton and Bitcoin. So like this just gives you an idea. So this is that data that I got off this Keiko website. It's, so if anybody's interested, I posted it in our alpha section of our community alpha section on our Discord. So if you want to go in there and you want to read through this, I posted a link to it if you want to check it out. So anyway.
I mean, basically what you were just showing there, Mike, with the correlation between Canton and Bitcoin, when that correlation is sitting at 0, that means that there is none. And that's really good, actually, because what it tells me anyway is that if there is success for CC and Bitcoin dumps, then Bitcoin dumping does not impact CC. That's what that means.
That's my bullish thesis on it.
I like that.
Is that since launch, Canton has moved, and we showed it. Canton moves like on its own. It does not move like the rest of altcoins. It doesn't. Bitcoin doesn't dictate what it does. So that's kind of what why I hate to be like too bullish on any one project. That's why I'm always trying to find things that are wrong with the project, or are not necessarily wrong, but bearish, because I don't like getting in the mindset where I am a maxi on anything. The more bullish I am on something, the more I dig into it to find potentially things that could move against me. Because if you don't, you end up being dwelling in these echo chambers where you only seek out that confirmation bias that David always talks about, that we see in so many communities, where you just surround yourself with people that are just hyping you up and feeding you bullish information, and you don't actually look into it. You're not critical of it, and so you just take it at face value. It's like they said it's bullish, so it's bullish. I'm going to buy more of it, and that's the trap where I would tend to agree with David, where when some of these assets are going down and these people just keep feeding you bullish news, ignore price. They're trying to institutions are trying to fudge you out so that if you have
it's so horrible.
If you have paper hands, they're trying to
it runs contrary.
For cheap.
No, I know they all say that stuff, man. They all do. I was just yesterday, for the first time, Mike, I spent an hour during the premium call with a couple of the guys in my DeFi University school community, going over a big XRP guy. We reviewed a piece of his content, and man, it was really, really entertaining. I'll tell you that much, because these guys, you would think that with all of the time that they've spent making content, and a lot of them make a lot of money, you would think that they would have learned a thing or two, but I guess they didn't go to the Leering Center, so, or maybe they did go to the Leering Center, and maybe that's the problem. I can't quite tell, but regardless, man, it was entertaining.
Yeah, no, and that's kind of why we discussed on Sunday during our meeting, that me and Jeff are going to start doing some deep dives on some of these content creators to not necessarily, and this shouldn't be seen as like we're trying to attack other content creators, because we hold ourselves to the same standard. We just want to highlight that either not maliciously, they're either on purpose or they are.
So that's something I want to stay away from. I want to stay away from, trying to get into someone else's head, into their mind. I can't read their thoughts. Exactly. So I don't know if they have malicious intent or not. There's no way for me to know that. So all I'm going to do is say like, hey, this gentleman right here who's talking about whatever he's talking about.
This
right.
Is the truth.
Yeah, he said this, and that's incorrect because, Exhibit A, evidence in the Intel library.
That is exactly how we are going to approach it. Is, and we're going to try to show a pattern. We're going to, again,
there's a clear pattern. It's everywhere.
Well, and again, we're going to do it to ourselves too. Like I said, there's been a lot of projects that, since the beginning, since we started DeFi, crypto, and airdrops, before it was the node. Me and Jeff have said from the beginning, we are learning about crypto, and DeFi, crypto, and airdrops was all about sharing our journey as we learned about crypto and DeFi and, these, the different things that, mistakes that we've made, successes we've had. We've never claimed to be experts. We are just trying to learn along with you, and we're trying to share our journey. So hopefully some of you out there can avoid the stupid mistakes that I've made and that David's made and that Jeff's made. We are genuinely here to educate. We do not want to influence you in any way whatsoever. We want to hopefully give you good information, good knowledge, so that you can continue to do deep dives and do your own research and make a more informed decision on what you do and don't invest in. And that's what we're going to do. Oh, go ahead.
It's about building a skill set. It's just about building a skill set. And I see what Crispy's saying about getting sued for libel and slander. Brother, listen, we're allowed to make reaction videos to anyone on YouTube. Yeah. So we're not going to take it too far either. Number one, we're never going to use profanity. We're never going to attack someone personally. And we're only going to say, hey, you know what? I don't understand how you can make this claim because I've got this piece of evidence here that contradicts what you're saying.
Exactly.
So
slander would be like an unsubstantiated personal attack that hurts them, financially. Or
we're never going to do that.
We're not going to do that. We're just going to say they're claiming this. This is the documentation. This is the announcement. This is the facts. That's it. Yeah, like David said, we're not going to try to pretend like we know what's going on in people's heads, or if they're paid shills or anything like that. We're not going to make those claims. We're just going to play the video clip of them claiming something, and then we're just going to fact check it. And if they're right, they're right. If they're wrong, they're wrong.
That's it.
That's not slander.
No personal attacks, no profanity. No trying to, say that someone's a scammer or not. You can't say that. But what we are going to do is pick apart their arguments and present our own evidence. And our evidence, it just comes from, Google. We don't have some special magical well of evidence. It's just Google. Yeah.
So Crispy, I know what you're talking about. Jake Clever sued, what's his name? Not Mickle. It was Zach Rector. But Zach, my understanding from the research I did is Zach Rector made some very, some very specific claims about Jake Clever, and he didn't have anything to support those claims. So that is where slander comes in. Is if you're saying that somebody is a thief or a scammer or something like that, and you don't have evidence to support that, that's kind of why I push back on that that terminology when talking about XRP and Ripple and things like that, is because I don't see it as a scam. They're fully transparent that they sell XRP potentially on a monthly basis. I'd have no evidence that they pay anybody to talk about the project. I'm not going to make claims that are unsubstantiated.
You're right. We can't do that. Yep.
Yeah. But pointing out that they sell XRP from time to time from that escrow is 100% public knowledge. They admit it. XRP community admits it. It's on chain. Everybody can see it. It's a statement of fact.
And I think, Mike, all we got to do to make sure that we stay safe is that for any claim that we make, we've just got to have some type of evidence to be able to back it up. And also, we can't make any of those personal attacks. We can't, call anyone a scammer or a thief for any reason. If the only way that we could make that claim is if someone has been found guilty of that crime in a court of law. We can't otherwise do that. Exactly. So, man, I just want to be able to.
Like SBF. You can say SBF is a scammer. It's like he was found guilty in a court of law that he stole billions and billions of dollars from customers and was using it to basically party it up.
Yeah. So with that Alameda chick too.
Oh, dude.
Oh, gross.
All that money, that's the best he could do.
Right? What the fuck? I know, man. I know. So you want to transition here on over into the Intel library?
Let's
do it, man. Let's check it out. So today, why don't we start off with Avalanche? and then we'll move on into Binance. I want to spend the remainder of the time here, most of the time, talking about Binance. I think that this will be a really interesting piece of content. So I want to start off with AVAX first, though. So Avalanche, here we go. And let me know, Mike, if you can't hear this. I'm just going to move this over to the other screen so that I can see you.
The Avalanche network was originally built around a heavily integrated monolithic core, but that structure proved too rigid for global scale. With a single network upgrade, that dense center fractured outward into a sprawling constellation of autonomous, independent nodes. This was the Avalanche 9000 upgrade, deployed through the Etna hard fork. It transitioned the network from its original subnet model into a decoupled architecture of sovereign Layer 1 blockchains. By reducing deployment costs by over 99.9%, the financial barrier to entry vanished. This led to immediate real-world outcomes, such as the California DMV migrating 42 million vehicle titles on-chain to streamline their transfer workflows and combat fraud. This architectural flexibility introduces a new set of economic variables. The network moved away from massive, static capital lockups in favor of a dynamic, mathematically constrained fee-burning engine. To understand the 2026 valuation of the AVAX token, we must evaluate whether this dynamic burn engine can survive the structural risk of value leaking away into custom gas tokens. Before 2026, application-specific subnets on Avalanche were deeply coupled to the primary network. Every node operator wishing to validate a subnet faced a strict financial barrier, a mandatory upfront self-stake of 2,000 AVAX. Each validator simultaneously synced and processed data from 3 distinct environments, the C-chain, X-chain, and P-chain. Launching a minimal 8-node subnet required an upfront collateral of 16,000 AVAX. This hardware coupling introduced systemic risk. A C-chain transaction spike could directly degrade an isolated subnet. These rules also legally barred regulated enterprises from the ecosystem, as they were prohibited from validating public permissionless blockchains like the C-chain. The legacy architecture prioritized integrated security, but it inadvertently created an unscalable financial and technical roadblock for institutional developers. Avalanche Community Proposals 77 was the surgical solution designed to dismantle those monolithic constraints. ACP-77 works by severing the connection between Layer 1 validators and the primary network execution layers. This operational shift entirely eliminates the mandatory 2,000 AVAX staking requirement. The remaining partial sync is strictly limited to tracking validator set updates and native interchain messaging. This separation provides complete fault isolation, ensuring that congestion on the main network no longer impacts sovereign L1 performance. The result is a 99.9% reduction in application chain deployment and onboarding costs. While ACP-77 allows for the deployment of a vast number of independent chains, it simultaneously altered the network's original tokenomic foundation by eliminating its primary supply sink. Removing the 2,000 AVAX mandate destroyed the artificial scarcity that previously supported the token's market value. To maintain economic health, a network needs a token sink, a mechanism to systematically remove tokens from circulation to offset inflation. To replace the upfront lockup, the network introduced a continuous subscription-style P-chain validation fee. This continuous fee covers memory costs for storing active validator states. Unlike the old subnet lockup that eventually returned capital, this continuous fee is permanently destroyed. This burning offsets algorithmic staking emissions. Currently, half the eligible supply is locked in staking, generating yields for delegators. For the network to experience net deflationary pressure, the 100% protocol-level fee-burning engine must outpace these new emissions. The network has traded the inefficiency of a few highly capitalized subnets for a future of thousands of active L1 validators continuously paying micropayments. Avalanche has transitioned its core tokenomic model from an artificial, temporary scarcity to a permanent, utility-driven deflationary engine. The rate of this continuous validation fee is not arbitrary. It is controlled in real time by a dynamic exponential pricing algorithm. This equation calculates the L1 validator fee. The minimum fee rate establishes a baseline cost of approximately 1.33 AVAX per month per node. This cost is measured against a target threshold of 10,000 active Layer 1 validators. As long as the network operates below this threshold, the cost to run an independent chain remains low and highly predictable. But what happens when ecosystem adoption pushes past that target capacity? This graph maps the relationship between network congestion and the cost of validation. The moment the active validator count crosses that 10,000 threshold, the fee structure shifts. The data line instantly bends into a sharp exponential upward curve. The rate control constant within the equation dictates how rapidly this cost scales. At the extreme end, if the network reaches its ceiling of 20,000 validators, the fee is programmed to double every 24 hours. This design prevents network denial of service while aggressively incinerating AVAX supply during periods of peak global demand. Net base layer deflation is mathematically guaranteed only if adoption permanently crosses that 10,000 validator threshold. Despite the engineering achievement, research analysts have raised a significant structural critique of this architecture. It is known as the custom gas token dilemma. Sovereign Layer 1s have total autonomy to run internal fee markets on their own native assets, completely bypassing AVAX. This paradox means that massive local execution value often fails to transfer to the base layer. A gaming network processing millions of daily transactions captures that value within its own token, while only a thin trickle of value returns to the Avalanche P-chain. The math is unforgiving. An L1 processing 100 million transactions daily burns the exact same 1.33 AVAX per month as a dormant network processing only 10 transactions. This modular dispersion also fragments capital, leading to a visible contraction of shared DeFi liquidity on the C-chain as users move to specialized environments. Avalanche has successfully addressed the technical barriers to building application-specific blockchains, but it traded away mandatory economic capture to do so. The long-term appreciation of AVAX now relies on a network effect race. The ecosystem must attract enough adoption to permanently trigger that exponential burn threshold before the custom gas token model leaks away the network's value.
That doesn't sound too good for AVAX anyway.
No.
I was able to raise my desk, so yeah, that's much better. So if we just take a look at AVAX, the token, and let's just bring this up real quick. AVAX USDT over here on Binance. Let's check this thing out. So this is one of the poorest performing tokens this bear market. Now AVAX during the last bull had a really nice rally at the beginning of the last bull. From like $9 all the way up to, what was it, 65, almost 70, $65 at the peak there. So really nice rally for AVAX at the beginning of the last bull, but all it did was put in a series of lower highs, to start off the bear. And now it is trading, I think, below its, it is trading below its lows from last bear. So there's a bunch of alts that are trading below their lows from the last bear market. And that's just not good. It's just a signal of structural weakness, lack of.
And there's still a lot of time till October when a good amount of people, very smart people, say that is potentially going to be the bottom. So there's still more potential downside.
I certainly think that there's the potential for more downside. I'm just not convinced that suddenly the Bitcoin cycle has ended, and that this Bitcoin bear market we're going to see a low put in July. I don't think that that's likely. I think that we see the low put in the fall, just like we see that every Bitcoin bear market cycle. So the low in Q4 is what I continue to wait for, but July tends to be a bit of a positive month during the Bitcoin bear market. So but bringing it back to AVAX, Mike, do you know of any, are there any legit projects on here? If we hop on over to DeFi Llama, I think there are.
Off the Grid was I never played it, but it looked like a really cool first-person shooter that was launched on AVAX. But from that video we watched, it looks like that even though it was built on AVAX, that much of the value accrual was for its token, and I think it was called Gun or something like that.
Yep, Guns
And
with a Z.
yeah,
Yep,
and not the AVAX token.
right. So that's what it looks like from that video. That the value doesn't seem to accrue to AVAX itself. And just taking a look over here at DeFi Llama data, I mean, 471 million in DeFi TVL. That's not nothing. That's a lot, compared to many other chains. But if you compare that to where Avalanche was back in November 2021, at 11 billion. So, Mike, I remember in 2020 and 2021 going to hackathons at UC Berkeley, and everyone was gung-ho on AVAX, especially for gaming and GameFi. And that entire narrative never really seemed to pan out, So, and you just take a look at the chart of TVL here, it doesn't look all that hot for AVAX. Now, as I scroll down and take a look at the protocols that are on Avalanche.
If you look at RWA.XYZ, though, it's number 6, right after Hyperliquid, with 1.2 billion in TVL. It's up 27% in the past 30 days. And it's captured 3.6% of the market share of RWAs.
So that's an interesting point. Think about the protocols and chains that Avalanche has to compete with. So Avalanche is number 6.
There's still a lot that you'd have to dig into with that. Is that static? Is that static TVL that isn't moving, generating fees? There's a lot of nuances to that. I just want to point out that it's not that it's not being used. It's just that it's being used, and it doesn't seem like the price is really reflecting that right now. Do with that as you will.
Yeah, it seemed to me, Mike, from the video content that we watched, that there may not have been a super solid value accrual mechanism, and really maybe not a super solid fee generation mechanism to the AVAX token. So
that's true of a lot of these early projects.
Oh my God, Miss V. Should we send the chat?
Oh yeah.
I love it, dude. I love it.
That's true of like 95% or more of crypto projects and crypto tokens. Is there's either poor or no value accrual for the token. So it's really, in my opinion, pointless to own the token other than for speculative trading or speculative pumps. Basically short-term buying and selling of the token for buying it lower than you sell it for, and hoping for those buy the rumor, sell the news events and things like that. That's if a token lacks value capture, that's really what you're investing in. Is you're investing in that there's going to be enough hype, enough interest, enough mind share that the token price pumps so that you can sell at a profit and use somebody else's exit liquidity. I hate to put it bluntly, but that's really all it is.
So if I'm taking a look over here at RWA.XYZ, and we're looking specifically at Avalanche, all of its chains here, this isn't bad. Definitely not bad. I like how it's Black Rock. The rock is black. Is the number 1. It seems that BlackRock is number 1 here. And then you got Janice Henderson, Anamoy, AAA, CLO. I mean, it's really hard for me to get excited about this type of stuff because I do believe that it's going to be winner take most. And so I think that the best RWA chain is going to be the one that gets, the vast majority of the TVL, and then everything else just kind of falls by the wayside. So it's really cool to see this start.
Right now, the top 3 is Solana with 10%, BNB with 11%, Ethereum with 48%. As far as distributed, obviously, if you go by the represented, then you got Canton that has 86.67%. You got Provenance that has 9%. The XRP Ledger that has 1%, almost 2%. ZK Sync Avalanche is number 5. With 0.32. Basically, Canton eclipses everything, including Ethereum.
And it's not even close. It's not even close. Like Canton blows them all out of the water.
It depends on how you measure. Because so represented, what their definition is RWA tokens using the blockchain as a record-keeping layer, enhancing transparency, reconciliation, and operational efficiency without enabling on-chain investor transfer or distribution. Then you have distributed. Distributed is RWA tokens using the blockchain as a distribution layer, enabling on-chain investors to subscribe, hold, and manage assets directly through their own wallets or custodians. So distributed, in my mind, to summarize, is basically retail. Represented is institutional, is the way that I'm taking that. Because if, distributed means that we're able to self-custody, whereas, Canton is not, focused on being a retail chain. What other people build on it is another story, but the chain itself was purpose-built for banks and institutions as a communication layer or rails between siloed networks, like banks and institutions, the privacy. So, that's kind of how I've, reconciled those two different, definitions. Is, if you go by what is being adopted the most for retail, you're looking at Ethereum. If you go institutionally and bank-wise and government-wise, what's being adopted most is Canton.
Yeah, and you can see that borne out in this one chart or this one table. You got Canton number 1, Ethereum number 3. Provenance is, I think, an EVM chain layer 2. And then you got XRP number 4 and it says total value. So I'm assuming that the vast majority of this is probably their RLUSD stablecoin product. And then you got BNB chain, 3.9 billion, and Solana, 3.6 billion. So I don't think that the future is going to be just a single chain to rule them all. Nothing like that. I think that it's going to be multi-chain, but I think that the multi-chain future is going to be where, the winner takes most of the market share.
You'd be correct about XRP. Like like almost just shy of $1 billion worth of the TVL is RLUSD, their stablecoin.
Yep. So that's basically, whenever I see stables, I think treasuries. So, alrighty, what's going on the BNB chain? Let's take a look at this one, because we're about to take a look at some deep dive research on this. We've got Circle's product, it looks like. So if I just zoom out here so I can see this more clearly, and what do we have going on? So we've got Circle USYC. So I'm pretty sure that that's their yield product, that's Circle's treasury product, like retail-facing treasury product. Now, I've done some research on that, and a lot of these treasury products that retail can swap into, where like the minimum trade size is not $2 million, like I think it is for some of the others. USYC, I'm pretty sure that when you swap into this thing, that there's like a 30-day lockup period, I think. So to find out if I'm right or not, I want to just verify that claim that I just made. USYC, Circle USYC. Okay, so here it is. This is a tokenized money market fund backed by US Treasury bills, designed by Hashnote Labs, now a part of Circle. So let's take a look at the website for this thing. Okay, it says, wow, I've got a VPN on too. Like, this is a protected area. Get started. See, these things are region protected. And just think about how ridiculous that is, that as a US citizen, you can't even get access to the majority of these RWA products, be it tokenized equities or tokenized treasuries. Like, you can't even trade this stuff. Like, how does that make any sense? Totally nuts. So yeah, I think I probably need to change the region that I've got my VPN connected to. How about I just go to usdc.com? This is, probably one of Circle's websites for developers, for business, learn, use USDC. I'm almost positive that USYC, when you swap into it, not only do they charge you a lot of fees, but I'm pretty sure that they also lock up your capital. You can't exit for 30 days. I'm pretty sure it's 30 days. So it might not be, but I'm pretty sure. So don't hold me to that. But we can definitely find out. And the easy way to find out would just be to hop on into Gemini and ask. So that's what I'm going to do. I'm going to say, is there a lockup period for USYC when I swap into it? And the reason why I'm talking about USYC is because we're going to hop on in here to the node.pro, and we're going to take a look in the Intel library at our next piece of deep dive research, which is on Binance and the BNB chain.
You ask it about that lockup period, I'd also ask it to cite its source so that you can verify it.
Okay, so it looks like the answer is no. So there is no structural lockup period when you swap into USYC. I was incorrect. It says you're not forced to hold the token for a minimum number of days or weeks before you're legally allowed to redeem it. However, because USYC is issued by Hashnote, which is a Circle company, it's an institutional tokenized money market fund and not a standard retail stablecoin. So it operates under very specific liquidity and access rules rather than a traditional time-locked constraint. So here are some of the things to keep in mind. USYC utilizes a, quote, smart contract teller system backed by Circle's infrastructure. So if you are an approved participant, don't quite know what that means, then you can interact with the teller widget or API to swap your USYC back into USDC 24/7, 365. So here's the catch. Redemptions are near instant up to the fund's instant redemption capacity. So you've got this immediate buffer of USDC liquidity that's held on chain. So if you execute a really, really large redemption that exceeds the daily on-chain liquidity, then it's going to process T+1. So there's also, it looks like, strict whitelisting. So while there isn't a time lockup, there is a permission lock. So you cannot simply buy USYC on an open DEX, a decentralized exchange, and hold it in a random wallet. USYC represents actual shares in a Cayman Islands regulated fund. So to swap into it, your wallet address must be explicitly whitelisted or allow listed via an onboarding KYC AML process. So if the wallet is not whitelisted, then the smart contract will actively block any transfer or swap attempt. So there are, it looks like, investment minimums. And the standard minimum to mint or interact with the primary fund, according to Circle documentation, is $100,000. And there's a 0.04% subscription fee and 0.03% redemption fee. I mean, dude, all of these money market funds on chain, they fucking suck. Like, ugh. So let's take a look here. We've got some information about BNB. Let's learn about BNB. And that's the whole reason why I was talking about USYC, is because USYC, according to RWA.xyz data, Circle's USYC is by far the largest asset on the BNB chain, largest RWA asset on the BNB chain. So that's why I was just spending some time talking about USYC. So let's bring it on back over here and let's hit play.
In 2017, the BNB token launched as a discount for a centralized exchange. Today, it operates independently as the governance anchor of an optimized ecosystem. Following a structural migration known as the BNB chain fusion, developers eliminated the network's reliance on external ledgers. It became a fully sovereign, self-contained Layer 1 infrastructure. By 2026, that infrastructure supports the largest deployment of decentralized applications in the blockchain sector, hosting over 5,700 active dApps. Those applications have processed a cumulative historical volume exceeding $12.5 trillion. This trillion-dollar maturity is the result of a highly engineered feedback loop. The network combines hardware scaling and autonomous commerce protocols with a regulatory-compliant economic model to drive demand. This model illustrates the 2026 BNB ecosystem as a unified, three-layered architecture. The foundational infrastructure layer handles the hardware and consensus upgrades required to completely eliminate execution latency. Resting on top is the application layer, a specialized environment built to host high-frequency AI agent economies and tokenized institutional real-world assets. The final component is the economic layer. This engine captures the value generated by the applications below it without violating global securities laws. To understand how the network securely absorbs billions in value, we have to start at the bottom and examine how it achieves sub-second hardware finality. Early Ethereum virtual machine architectures were strictly bottlenecked by their block generation times, stalling at 3-second intervals. Through a sequence of aggressive hard forks in 2025, engineers systematically cut block generation intervals in half, pushing times down to 0.75 seconds. The 2026 Fermi upgrade pushed that limit further, dropping intervals to 0.45 seconds, pushing throughput to 130 million gas per second. Moving data at this speed introduces the risk of chain reorganizations. To secure the consensus, developers implemented the BEP 590 fast finality voting rules. These updated rules cut irreversible transaction confirmation times down to approximately 1.125 seconds. Executing at this pace breaks traditional software. Go-based clients like Geth stall at extreme speeds due to garbage collection pauses during memory cleanup. Migrating validators to Reth, a REST-based architecture that handles memory at compile time, eliminates those pauses entirely. The deployment of Reth 2.0 optimized state storage further by keeping sparse tri-structures completely in memory. State root calculation times dropped to 2 milliseconds, allowing the client's remote procedure call layer to process up to 16,000 requests per second. Operating at 20,000 transactions per second is the strict engineering prerequisite for hosting the next generation of digital commerce. This high-speed environment supports agentic finance. In this model, autonomous AI agents negotiate, collaborate, and settle financial transactions on-chain.
So I just want to ask something real quick for anyone in the chat. Have you guys used BNB chain recently? Because I haven't used the BNB chain like super recently, maybe like a month ago did I use it last. So my question to everyone is, how fast and how cheap is it? You know, I haven't used it recently.
To prevent these AI programs from relying on centralized third-party servers, developers utilize open smart contract standards provided by the BNB Agent SDK. The ERC 8004 standard issues each AI agent a unique on-chain identity token to anchor its profile. This allows other agents to verify performance data. Once verified, agents interact through the ERC 8183 Apex protocol, a decentralized task management and payment escrow system.
This is good stuff. Doesn't this remind you a little bit of the base chain, Mike? Just kind of, sort of?
Yeah.
For continuous services, X402 embeds stablecoin payments directly into HTTP requests, allowing agents to pay for API calls and language compute in real time. Powered by the Fermi infrastructure beneath it, these X402 agent-to-agent micropayments settle in under 200 milliseconds. This combination of sub-second settlement and low fees has attracted institutional financial issuers, growing the network's tokenized real-world asset sector to over $1.8 billion. The infrastructure attracted massive AI and institutional transaction volume. The final challenge is legally capturing the value of that volume for token holders. The network generates massive fee revenue, but distributing it directly to token holders is a severe legal liability.
So this is what we're always talking about, value accrual, right? And I've got a fundamental problem with this Howey test. You see, in DeFi, code is law, and the fact that these protocols have to abide by some arbitrary rule that was put into place God knows how many years ago for TradFi assets, I got a problem with that.
This goes back to what I was talking about, where there's this fundamental issue right now with, how early we are, that there isn't legislation, that, definitions of a lot of this stuff is, need to be updated for, to include, how this new technology works. Because, if we just, copy and paste, the old, the old Howey test, for securities to a lot of these digital assets, potentially, if the tokenomics are such, then they could be seen as a security, because if they are,
because they are, because a lot of them look like it.
A lot of them are, using that, that measure, that ruler, because, some of them, they did or do have something in their tokenomics where they directly pay token holders. And that is part of the Howey test. If it's paying dividends, for all intents and purposes, then it, is one of the pillars, is my understanding, is one of the pillars of the Howey test. There's like 4 pillars that, that they have to hit, for it to, pass or fail the Howey test.
So, and this is just a pure hypothetical situation here, but imagine if with the text of that Clarity Act, if they say that a token that or a protocol that generates revenue and uses those revenues to buy back and burn its tokens, if that makes it a security, oh, dude,
we're screwed.
That's like most of DeFi.
Dude, that's hype. That's aerodrome. That's freaking, basically anything that we're bullish on right now. Hell, that's freaking Canton.
Yeah, but that's what I'm saying though. Like, these laws in TradFi land, they really shouldn't apply to anything in DeFi, in my opinion. I think in DeFi, code should be law, not what some politicians somewhere say.
But that's why it's so important that we, understand how early we are. And even though we're bullish on Canton and Hype and Tron and a lot of these other projects, it doesn't mean that they're going to be successful. Like David was just talking about, if we don't get the Clarity Act and, these midterms go the wrong way and we get, a bunch of Democrats that historically have been hostile to
America, hostile to America.
Well, hostile to America, but hostile to crypto. And in 2 years, from this November, if we get, a president that's, Democrat or Republican that's hostile towards crypto, and they get something to pass that has verbiage that makes it to where basically we, the token holders, aren't allowed to make any money whatsoever.
You will own nothing, and you will like it, and you will eat the bugs.
That's kind of where everything seems to be going with, inflation, and, wages not increasing, but the cost of everything going up. And, it seems like that they're just, hell bent on, us basically, being hamsters on a wheel for, the elites to, live their lifestyle.
It's tax slavery, Mike. That's what it is. The dollar is the ultimate shitcoin. And really the system that we live in is literally a tax slave matrix. Now, there are amazing benefits to living in the United States. Don't get me wrong. America is the greatest country on earth, period, full stop. However, we fought a revolution 250 years ago because of a 2% tax on tea. And now people are talking about 50%, pay your fair share. It's like, dude, like, what are you talking about, man?
Like, what is your definition of fair?
It should be zero. It should be zero. Back in the day,
instead of arguing who should pay more taxes, we should be arguing about why we're paying taxes.
I think that we should be arguing about just how quickly we need to cut all taxes to zero. So let's keep playing this here.
Under the SEC's Howey test, if the network pays direct cash flow dividends, the token is classified as an unregistered security. This regulatory reality is exactly why institutional products, like the VanEck Spot BNB ETF, explicitly strip staking yields from their U.S. filings. The ecosystem bypasses this constraint by capturing value through programmatic scarcity rather than dividends.
So that's what we were just talking about, the programmatic scarcity. If that is Yeah, so that's the legal loophole. But if that loophole gets closed, with whatever the text of that Clarity Act ends up being, well, then, that's kind of a big problemo for most of DeFi.
This equation illustrates the first mechanism of the dual burn engine, the quarterly auto burn. Notice that the variable P, representing the average spot price, sits in the denominator. Because of this placement, the formula acts as a counter-cyclical stabilizer. When market demand is weak and the spot price falls, the mathematical output increases. The protocol programmatically destroys more tokens, tightening the remaining supply. The second mechanism is the BEP95 protocol, which executes a real-time gas burn continuously at the execution layer. At the close of every single block, a programmatic ratio of the validator gas fees is permanently destroyed. Tied directly to usage, BEP95 acts as a pro-cyclical driver. Every AI microcayment and institutional trade physically destroys a fraction of the total token supply. Combining these burns functions like a corporation executing aggressive stock buybacks.
Okay, so something else that I don't know whether it's going to mention in this video or not is Aster. Now, Aster, because it's basically, Binance's Perpstex, Aster has something to do with this BNB burn. I'm almost 100% positive that Aster has something to do with this, which is actually, a virtuous cycle for the BNB token. So just wanted to point that out there.
Concentrates equity value into a shrinking asset pool outside the crosshairs of regulators. The infrastructure, application, and economic layers of the entire ecosystem now connect into one continuous, self-feeding mechanical loop. First, the Fermi and Reeth upgrades provide the required sub-second execution speeds. Second, that execution speed attracts a massive, high-frequency volume of autonomous AI agents and institutional assets. Third, that agentic volume generates an ocean of gas fees, which directly fuels the BEP95 incinerator. As of the 35th quarterly burn, the network has successfully and permanently destroyed nearly 33.
Oh no, what happened? Sometimes these videos, they just kind of cut off mid-thought. Okay, well, so there is definitely a value accrual mechanism here for BNB. And I believe that the Aster...
We'll take a look at the chart real quick with BNB, its correlation to Bitcoin, like as far as performance.
Sure. So here's...
No, go ahead.
Yeah, so here's just BNB in US dollar terms. Now, if we go ahead and say, okay, BNB in Bitcoin terms, like this, well, let's go ahead and zoom out to a weekly, because BNB is one of the tokens where we've got a little bit more data. So if we zoom out here to a weekly, this is good. This is what outperformance looks like.
We're starting to see kind of a validation of our trifecta. It seems like the tokens that we keep running across that have good value accrual and that are generating fees, and they have adoption and things like that. We're starting to see that price, relative to the rest of the market, is they're much stronger, when it comes to price appreciation.
I agree. And so that's why we focus on the trifecta, because if there's real user growth and real user adoption and product market fit, and there's revenues that are generated, and those revenues, accrue to token holders, well, number go up for the token. And usually number go up for the token in Bitcoin terms, which is like the most important thing. Like if you're going to hold an altcoin, it's got to be outperforming Bitcoin. If it's not, then it's kind of difficult to justify holding it. So, BNB, since it launched in 2017, this is what, or at least these data go back to 2017. This is what outperformance looks like in Bitcoin terms, up and to the right. There's a handful of other protocol coins that have also outperformed Bitcoin over the last, maybe 5, 8, 9 years, the ones that have existed for a long time. And then there's some recent coins that have also outperformed BTC. So I'll give you another example of a coin that I think has potentially outperformed BTC. So this is Tron, and just recently it has started to outperform BTC. So basically, since May of 2024, the start of this last bull, or the early innings of this last bull market, Tron really started to outperform BTC. You can see that here, up and to the right. This is Tron in Bitcoin terms. That is Tron outperforming Bitcoin, and the outperformance really accelerated at the start of this bear market for Tron. If we take a look at something like Canton in Bitcoin terms, Canton has also been one of the assets that has outperformed Bitcoin. And what we can see here is up and to the right. Now, I was talking about this just the other day, where if Canton comes down and tests this level, so notice you've got this channel, right, where Canton was trading within this channel for weeks and weeks and weeks, and this is in Bitcoin terms, and then it broke out in Bitcoin terms, and now it's coming back down and retesting the breakout. So this level of trend line, what is now trend line support, if this holds, well, then you might expect Canton to bounce against its US dollar pair. That could be an expectation there. So yeah, let's see what else do we have going on here, Mike. Let me take a look here. What else is outperforming Bitcoin? You could take a look at Hype, maybe. Hype in Bitcoin terms. Let's take a look at this. And yes, sir, this is big. So this is what outperformance looks like, no doubt about it. One of the best, virtuous flywheels out there. Hype has one of the best flywheels for sure. So
that's, and to be fair, I mean, that's because it's such a utilized platform. That it's DEX does so much business that it's generating those fees that allows for that programmatic buyback and burn to make it deflationary. I would guess that if something came along and took that mind share, took that volume, took that fee generation away from it, and it became inflationary again, we could see the price dump. So we want to make sure that we're painting the whole picture here. It's like, yes, we're bullish on these projects, we're bullish on the the mechanics of them and the tokenomics of them and things like that. But we need to be realistic. I have a small bag of Hype. I bought it. I'm up about 56%, on my buy. But we need to understand, how what it is that we're investing in, and what is working to our benefit right now as it relates to Hype could potentially hurt us if the situation changes. So understand that, before you go, buying into these assets. And that's why we do these deep dives. That's why we tell you, don't just take it for face value. It should give you a jump start, to becoming knowledgeable about these, a starting point, but you still need to do your own research. You still need, because we can make mistakes. The things that are in these deep dives, yes, they're generated, the videos and things are generated by AI. I go through as much as possible and I fact check it and I try to make adjustments, but I would say probably like 95% of the information's accurate. So you still need to make sure that if you're going to invest and you're going to be a smart investor, you need to go into the source document, scroll to the bottom. The last couple of pages have our hyperlink sources. We cite all of our sources. Check those out. Make sure that they check out. If you find any errors, please bring them to mine or David's attention. We are more than happy to make adjustments to any of the deep dives if you're able to find something that we put in there that is not accurate. We want to make sure we're getting good info.
Want to put out the truth as much as we possibly can. So, we can take a look at Pendle real quick. Let's take a look at Pendle. Here we go. Pendle, up almost 7% today. And it bounced at support. So found support, was able to bounce, And if we zoom in, we'll be able to see that level of resistance on the upside. So basically, if Pendle can make it above here, $1.55, if Pendle can make it above $1.55, then that really signals a potential swing to the upside. This is a daily chart. It's sitting at the 200-day moving average. That's resistance. It's also got resistance just a little bit higher, that horizontal at $1.55. This is an important level of resistance for Pendle. If it breaks out, it could run. Where would the target be? Somewhere up here, $2 or so. But it needs to break out first. And so I think that unless Bitcoin breaks out and continues to run, maybe up to 67K, well, then, if Bitcoin doesn't break out, I think Pendle would reverse, but we'll see.
And wouldn't it need to confirm that breakout?
It depends on what Bitcoin does, because this is still so positively correlated with Bitcoin.
I'm just pretending to be smart about TA right now.
Yeah, no, I mean, I wouldn't wait for the confirmation. If Bitcoin starts to run another couple $1,000s and Pendle breaks out above, not just its 200-day moving average, but also this level of horizontal support or resistance, excuse me, if it breaks out above the horizontal and the 200-day, that's a confluence right there. So that would be this is a significant level of resistance. So if it breaks out, then all of a sudden it's in this open zone where you see how there was a sharp breakdown. If it breaks out into this zone, you could see a sharp push higher. And Pendle's price action, it likes to put in pumps like that. So sharp pushes like this. So yeah, I could see this thing ripping. I could see it ripping, but it really needs to get above $1.55 and like really get it.
Crispy saying it's losing velocity right now.
Yeah, it very well could be. But if we take a look at a daily RSI, it's not overbought, so there's definitely plenty more room for this to run if it can break out. And so I think you're probably just waiting for Bitcoin to break out here. Now, take a look at what's on my watch list here, Mike. I've got Bitcoin, the king of decentralization, basically, one of the only actual digital commodities. I think that maybe you could say that Monero is also a digital commodity just because it's so decentralized, but maybe not. It depends on how you define a digital commodity. I think that Bitcoin's probably the only digital commodity. And then if you take a look at what else is on my watch list here, this is my shopping list, Ethereum and Solana. These are, retail, public-facing smart contract platforms. So I've got Bitcoin, the only digital commodity. I've got Ethereum and Solana. These are smart contract platforms. I've got Canton. This is my institutional play. I've got Tron, because everyone in Southeast Asia and Latin America who transacts in USDT is using Tron, and it's got a great value accrual mechanism. And then I've got Hype. I've got Hype here because, again, value accrual, user adoption, product market fit, revenue generation. That's Hype. Now, here's something to think about when it comes to Ethereum. Check this out, Mike.
I need you to stop hyping Hype.
I like Hype. Hype is great. So if Hyperliquid ever launches options, oh man, they're just going to eat TradFi. So this is ETH BTC. Now, here's something I think that is worth thinking about. It's
respecting the shit out of that trend line.
What happens if it doesn't? What happens if it breaks out?
If it doesn't, I mean, potentially, from a TA, I'm not a TA expert, but my understanding would be that it could do some freaking amazing things.
So, I mean, if ETH breaks out this level of resistance, so here's one thing about a level of resistance or a level of support. The more times it gets tested, the more likely it becomes that it breaks. Here's the all-time high for ETH in Bitcoin terms. Ethereum was worth 15% of BTC at the all-time highs. That was in June of 2017. That was the ICO craze. And people buying NFTs of rocks and shit.
Oh, so, don't get me started on that.
Oh, dude. So that was back in 2017. That was when Ethereum was at its highest valuation in Bitcoin terms in history ever. Now, the next lower high was the bear market, September 2022. So last bear market. And then you've got just basically a series of lower highs and lower lows since last bear. Now, you've got how many tests here? 1, 2. If we get another test and it breaks out, dude, ETH could rip in Bitcoin terms. So, that's something that I'm willing to speculate on, because I think that there is a place for these smart contract platforms moving forward, like over the next several decades. So Ethereum, I think that, look, I live on Ethereum. Solana, even though I think that there are some problems with Solana, there are problems with most of these new technologies. So are they going to be able to fix it over at Solana? I think so. If we take a look at Sol in Bitcoin terms, let's just take a look at Sol BTC. This is a very similar looking pattern to ETH BTC. And if anything, this one has more room to run. So, if once we get to the end of this Bitcoin bear market, Solana, could be a really interesting play just to get back up to resistance in Bitcoin terms. Not even to break out, just to get back up to resistance. That's 60% against BTC. Now, if it were to rip back up to its all-time highs in Bitcoin terms, then we would be talking about Solana outperforming Bitcoin to the tune of 250%. So that wouldn't surprise me, because Bitcoin kind of, sort of is a decentralized commodity pet rock right now. Like, it's not digital gold. It hasn't really outperformed the S&P 500 over the last 5 or 6 years. It definitely hasn't outperformed gold over the last couple of years. It doesn't really have any utility whatsoever, except for the fact that it's a decentralized commodity. There's no real dApps or anything on the Bitcoin layer 1. You've got a bunch of layer 2 chains that don't really accrue value to the layer 1. The mining business model is totally broken. And, in the absence of covenants on Bitcoin layer 1, I mean, it really needs some type of smart contract layer. It needs DeFi, because just because it's the largest and, one of the most widely adopted digital assets out there doesn't mean it can't die,
No, I mean,
So,
I always use Yahoo. Those of you that are old enough and remember, Yahoo was the search engine. It could not be dethroned, and they had a chance to buy Google for like $1 billion, and they passed. And when was the last time you used Yahoo?
yeah, it's kind of like Ask Jeeves and Yahoo, and there were a bunch of them. Remember, back in the day, there were a bunch of them. Where are they now? In the dustbin.
So, I mean, I'm bullish on Bitcoin, but I mean, it's not like it's impossible that it could go away. If people get to a point to where they cease to perceive Bitcoin as a store of value, if there isn't something like David's talking about, if there isn't covenants, if there isn't smart contracts, if there isn't DeFi, if there isn't something that generates fees and revenue, if there isn't something for Bitcoin that has a value accrual mechanism, why long term, why would anybody buy it unless they think they can sell it at a higher price than they bought it at? And so if people lose enough confidence in it,
I mean, yeah. So Mike, does AOL and MSN? That's right.
Yeah. When was the last time you used any of those? I mean, shit. It became like an official word in the English language to search something online, to Google it.
Right. Yeah. And when I think about Bitcoin, does Bitcoin satisfy our trifecta?
Oh, we did a deep dive on it. Absolutely not.
Right. Exactly.
If you solely just used our unit of measure, and not to say that our unit of measure is perfect, but we're starting to see that our unit of measure has a really good we're finding more and more projects that meet those criteria that are outperforming the rest of the market, including Bitcoin.
Yeah, I mean, yeah,
it satisfies that. Height, it satisfies that. Tron, it satisfies that. BNB, it satisfies the trifecta. Just all of these different projects that seem to be moving independently of the rest of the market. They meet those criteria. So I'm the more that we keep getting these data points, the more that I'm becoming more confident in the trifecta.
Yeah, and as much as I love me some Bitcoin, as much as I love BTC, man, yeah, it does not satisfy our trifecta, unfortunately. Does that mean I won't buy it? No, I will continue to buy it because there is that intangible, belief. So I continue to believe in BTC, but man, it needs covenants. It needs covenants really bad.
It needs something, because if they can't incentivize people to secure the network, by running nodes and things like that, or miners, the better term,
both, yeah,
then basically, the whole thing falls apart. So,
and then maybe you'll see Tom Lee become the next trillionaire.
Yeah, there you go. So, with that being said, if you found anything that we had to say here valuable, if you found it entertaining, whatever, if you could go down to the bottom on YouTube, give us a like, give us subscribe if you want to check out our other shows, and share this out. We are genuinely just trying to give good information here, and want a well-educated crypto community, investor community, so that you can invest in these assets, understanding what you're investing in, and not just treating it like a lottery ticket, or like gambling.
Exactly.
We want you to be able to mitigate your risk. So with that being said, we offer a ton of free information. So if you want to go to the node.pro, this is our official website, and you want to go over these deep dives on your own at your own pace, feel free. This is free at no charge. There's no tricks, no gimmicks. Go ahead and go through these. If you find anything that's wrong with them, please reach out to us. We're more than happy if you cite your source so that we can go in and verify. We're more than happy to make adjustments to these. But again, all of these different deep dives we offer at no charge. Other content creators, they charge a lot of money for things like that. Another thing that we don't charge for is our DeFi University. If you are a beginner, intermediate, or advanced, there is something for you in here. If you are brand new and you know nothing about blockchain technology and hot and cold wallets and things like that, this is going to get you up to speed. Again, this is no charge. We give this away. We are, and it's not totally selfless. We want to show you the value that we are willing to give away, so that you can safely enter these markets, at least with a base knowledge. With that, we do have paid add-ons. So if you want one-on-one coaching with David, yes, we charge for that. His time is valuable, just like all of your time is valuable. So we do charge for that. If you want to, but you can set up a no obligation one-on-one call, live one-on-one call with David, where you can go over where you're at in your knowledge. You can go over your risk profile. You can go over your portfolio, and together you can decide if you're ready, for that level of investment, of time and money. So if you or he doesn't feel like that you're ready for it yet, he might just tell you, hey, go jump on DeFi University, go through this module, and this module, and come back and see me, and we'll look at getting you into the coaching. Again, something else that we have is you can join the premium live calls. So if you want to check those out. On Mondays, Wednesdays, and Fridays, we do those. So that is a live Google Meet where you can meet with David and other members of the community that are, making money in DeFi strategies, advanced DeFi strategies and things like that. This is another one. You can try this out 1 week for free and see if there's value. Other places don't do things like this, where you can, peek behind the curtain. Try out 3 of the calls. If you find value, sign up. If you don't find value, don't. We don't want you to buy anything you don't find value in, and we're willing to give you these, free, free trials to make sure that you find value. We don't want to take your money unless you're getting something out of it. So, also, we have the newsletter. David's still working on this.
I'll get that working at some point over the next couple of weeks here. I'm going to get that working.
But there's still a ton of value here. Don't go and buy it. We're going to be charging $20 a month, once it's done. But there's plenty of value in there right now where you can go in, just as with anything, make sure that you're verifying the data. Anytime that you're hearing something on, our channel included, anytime you hear something from a content creator, an influencer, an educator, whatever you want to call us, jackasses, whatever, and make sure that you're verifying that information. You
verify, don't trust, always. Verify.
Always. So, there's news in here. We, hyperlinks, anything that we give information about, you can verify the data. So, go ahead and click through, but yeah, ton of value here. Our community. David's going to be building out basically a Discord style server here on our website. We recently had some issues where we had a community come in and raid us and reported some of the things that we were joking around about, and we got banned from our own Discord for about 24 hours. So we decided that we're going to decentralize. We are going to start moving as much of our social media natively onto our website as possible. We believe in freedom of speech, especially freedom of speech that we don't necessarily agree with. So I'm just going to build
a replacement for Discord right into our website.
Yep.
But so Mike, I gotta run, man. I got an appointment. So I appreciate you and everyone else. Thanks, man.
All right, take care. All right, and so and again, we don't charge for that. We give that away. We're probably going to discontinue the store. This was kind of something that it seemed like a good idea at the time, but honestly, I'm not a big fan of it. I do want to get some hats though, for my big bald head. But I think it just takes up space on the website. Don't really think that it's necessary. But and then last but not least, if you're interested on our programming. So today being Tuesday, we got the David's Daily Market Wrap at 4 p.m. Eastern, 1 p.m. Pacific. And tonight, me and Jeff will be going live with Crypto and Chill at 8 p.m. Eastern, 5 p.m. Pacific. And tonight, we're going to be going over, different influencers and content creators. So tonight, I'm going to pick one that, and we're just going to go through using their own words. We're not looking to, to disparage anybody or anything like that. We're just going to point out that, that we content creators need to be responsible for, the claims that we make. If we're giving out information, we need to make sure that it's accurate. We need to cite our sources, and we have a responsibility to make sure that we are being genuine about our stances. Again, that's why I'm so critical of even what I say about Canton, as bullish as I am about it, or any other project like Aerodrome. Acknowledging that things, and one of the things I'm going to talk about tonight, and it has to do with XRP, is there is a lot of communities out there that will present, bullish news that isn't really as bullish as they make it out to be. And I think it creates this false narrative of this like unlimited upside, where it's the chosen, the chosen network, where that is not the case at all. I am not seeing anything out there that any project, Canton included, has been chosen as the future of finance. I think it's going to be a handful of chains, with interoperability and things like that. Do I think the XRPL could have a part in that? Absolutely. But as we keep talking about on this channel, what part does the token play in that? And I'm not seeing the value accrual aspect. Are we seeing adoption on the XRPL? Yeah, we're seeing a bit. Are we seeing fees being generated? That can be debated. But any fees or revenue being generated is for the company Ripple. I do not see a mechanism in place for the token. There's no, other than the fees being burned, there's no mechanism in place or part of the tokenomics that shares those fees or potential fees and revenue with token holders. And that is a problem with the majority of crypto. I don't want to just pick on XRP. Cardano, was a big one when it comes to that. A lot of the older projects. We pointed it out about Bitcoin. If it didn't have the quote unquote store of value that everyone likes to latch on to, it has terrible tokenomics. What else we got here? Like Doge. It's basically community is what gives it almost a $13 billion market cap or valuation. It has absolutely nothing going on with it. Here, actually, I'll share this. As far as any kind of adoption other than other people buying it, hoping that the price will go up. There isn't like institutions building on Doge. There isn't any fees or revenue being generated. There's nothing in the tokenomics that allows Doge holders to to share in that. What else? Chainlink. We did a deep dive on Chainlink. Super bullish on Chainlink, the company. They are the interoperability layer for almost everything right now. But the token doesn't really have a connection to any of that. Any fees or revenue that's generated by the project. So, do I have a decent bag of Chainlink? Yes. But I am banking on the speculative pumps. I'm betting on that when we get a bull run or we see some positive price appreciation on the market overall, that because of the mind share and because of how many different institutions that they're working with and all the different things that they're doing, that is going to generate interest and people coming into the markets to buy it, to pump the price. And I'm going to sell my bag because I just don't see the tokenomics aligning with any kind of value capture. Can that change? Absolutely. But again, I'm judging these projects based off how they are currently, not what they potentially could, how they could potentially evolve. So anyway, I'll end it there. But I appreciate you all, and hopefully you join David for the market wrap and join us tonight for Crypto and Chill. And until next time, Veteran Crypto out.